Hi, I'm Kevin Dreyer, co-CIO of the value team at GAMCO. Inflation is front of mind for consumers and investors these days, with the latest report for CPI at over 9%. At GAMCO, we think one of the best ways to thrive in this environment is to buy franchise, cash flow generating businesses with pricing power. Historically, one of the industries with the best pricing power has been distilled spirits. Spirits is a $380 billion market at retail that is growing mid to high single digits. Price and positive mix effects from premiumization has always been a component of this growth. During widespread COVID lockdowns, the spirits industry saw increased consumption at home, partially offsetting dramatic declines in bars and restaurants, also referred to as on-premise. As we are now exiting most lockdowns, at-home consumption is proving to be somewhat sticky, while on-premise consumption is coming back strongly. This should provide a tailwind for the industry over the next year or so. One of our favorite companies in the space is Diageo, which is the global leader in spirits. The company owns iconic brands including Johnnie Walker Scotch Whiskey, Tanqueray Gin, Smirnoff and Ketel One Vodka, Bailey's Liqueur, as well as the Guinness beer brand. Diageo continues to grow its top line despite the economic slowdown and pinched consumers from inflation. For its latest fiscal year ended in June, the company reported revenue growth of 21%, driven by volume growth of 10% and price mix of 11%. The company also expanded operating margins by 121 basis points, despite continued input cost and labor inflation. These are pretty extraordinary results given the macro environment. One way Diageo has bolstered growth is by expanding its tequila offerings. Tequila is a $5 billion category at wholesale in the US and the fastest growing spirits category. Diageo owns two of the fastest growing major brands in tequila with Don Julio and Casamigos, which are benefiting from the ongoing premiumization trend for spirits generally and tequila in particular. The company's tequila brands now represent 10% of total sales and grew by 55% last year. Other than growth of the business, there are also ways that value could be surfaced for Diageo shareholders. While we don't expect anything near term, it could always separate its smaller beer business from spirits, and the entire company could be interesting for a beer or soft drinks producer who wants to enter the spirits business in a beverage market with increasingly blurred lines among categories. With all these positive business attributes and a reasonable valuation, we believe Diageo shares are an attractive investment. Thank you.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.